Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. Thank you so much for joining us on the show. On this week's episode, we're going to talk about the greatest mistakes we make as investors and how we can avoid those mistakes so we don't hurt our investments and we don't hurt our money over the long term. Well, to answer questions in the studio today, I have two gentlemen with me. Vipul Bhagwan Das is an investment advisor who joins us on the show. Aditya Joshi is a proprietor of Supreme Advice Investments. Thank you both for joining us. You obviously interact with investors on a daily basis.
Absolutely.
In your opinion, what is the biggest mistake an investor normally makes?
Normally, what investors do is they indulge very much in day-to-day ups and downs of the market. And as an investor, I think they should they should have a long-term goal, and they should try to see that how I can make a lot of money, or rather to meet my end goals of for the longer period.
Okay, and what about you?
See, basically, while investing, everyone has to look at from the asset allocation point of view. What mistake generally people make, what we experience is people go with the flow. If some asset class, XYZ asset class is doing well, people want to invest more into that and ride on to that rally immediately. So rather than doing that, stick to your goals, stick to basics, start from the zero and then take it forward. That should be the case.
So what you're saying is basically don't react to short-term reactions. So basically if the market is doing badly right now, don't let that worry you. Or if gold is suddenly doing well, don't make that change your plan. So both of you all said you should have a long-term plan.
Yes.
How does one arrive at a long-term plan?
First, they have to set a goal. While there may be different goals, my retirement planning, or other my child education, or my daughter's marriage, or whatever, or buying a house, or I want to buy a car, whatever. So they have to set their goals and then do the investment accordingly, so that they are they should also allot the fund, or rather choose the fund in such a way that their investment target is not hurt.
And if I were to ask you, what is a financial goal at this point? Because actually, I mean, just having a lot of money when I retire, is that a financial goal?
No, see, it will depend on each and every individual. So we cannot generalize, or we cannot arrive at a goal as a general thing. It will be individual based, and every investor or every person has to give that much of time, and he also, along with the financial advisor, has to realize what he wants to achieve over a period of time, and accordingly each and every goal will be set. So we cannot generalize the long term goal or short term goal. It has to be done systematically.
And once I've set my goals, how do I avoid the mistakes of taking the money out before the goal has arrived? How do I avoid the mistake of perhaps getting too greedy for larger returns?
Yeah, what happens normally when I have started some investment with a specific horizon, and then in between, if he is coming across with something else which he finds much lucrative than what he is doing, so he just get away along with it, and he'll switch on to something else, which may end into definitely a financial loss. He won't make much money there. Like people, when gold was booming around, exactly I remember exactly 2 years back, August 2013, it was around 33,000. People were selling all their assets and going for gold. What is gold today? So you don't just carry it away with the asset class which is booming, because every asset class is having a cycle. Whether it is a real estate, whether it is a gold, whether it is equity market, or whatever, every asset class is having their own cycle. So don't just carry it away with the time. Give enough time for your investment to reap, and then you enjoy the fruits of it.
Okay. There are a lot of people who believe that the most stable investment right now in the country is real estate, because traditionally our parents have always bought real estate, our grandparents have bought real estate. Very rarely do you have a very bad experience, except in the in the near term. What is your argument for people who believe that this is the only thing that I trust in?
See, we meet people who have asset allocation up to 80 to 90% in real estate sector. Our only argument to them is real estate has done well from 2008 to 2012. We have seen excellent cycle in real estate all over the country from 2008 to 12. As you rightly said that every asset class goes from ups and downs. So if you are having exposure to that extent in one asset class and with no liquidity, then how can you get money when you really need it? So real estate investments, whenever you are doing it, you have to do it as an asset class, and if you need it. We have seen people, those who buy second home just because his friend has bought it. So here envy comes to play or whatever comes to play. Like we experience that people go from our office planning that 60,000, 70,000 will go systematically into various asset classes. 10 days later he calls us and tells us that I am going to buy second home. We ask them where is the money, but he says that I am borrowing it from someone and I will repay it to them. So his entire planning goes for a toss. So
All right.
real estate
So
is a
be
big
very
problem.
clear about when you want real
And I would
estate.
like
and
to
when you
add
want
in this, real estate, yes, since 2003 the story started, the cycle started. By December 2013, real estate story faded away. Now that rates have, they're not going northward, but they are not coming southward also. But there is no liquidity. If you want to go and sell a flat you have or other real estate whatever you have, there are no buyers right now. And same thing happens even, I was just talking about gold. Gold for using as an ornament, yes, I can go and buy it at 35,000 and 50,000 also because it gives me pleasure. But just buying at 33,000 and keep it in my cupboard just for an investment, it's foolishness.
All right. We want to open the floor for questions. Does anybody in the audience have a question? Yes, sir. Please go ahead.
My question to you is, some mutual funds claim guaranteed returns. Do I believe in that?
There are no mutual funds giving guaranteed returns, for your information. And SEBI doesn't allow any mutual fund to give guarantee, to use the word guarantee for any mutual fund product, whether it is a debt product, whether it is a liquid product, whether it is a balance or a equity product. We cannot guarantee you anything in it. But yes, there are risks involved in it, and you can see in what category of risk you fall, and you can take a wise decision on it. We are there to help you out. We are there to advise you that according to your risk profile we can suggest you the product, but we cannot guarantee you the returns.
Whoever is giving you guarantee, please look at it with the suspicion. Apart from bank returns, no one can give you any guarantee.
So what bank is giving is an interest.
FD interest.
All right. So whenever someone approaches you with some sort of guaranteed mutual fund product, you know there's something wrong there, because nobody can offer you a guaranteed mutual fund product. It's against the regulations. We're going to take a very quick break. When we come back, we'll talk more about how we can become better investors. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET. Now remember, if you have a question for us, you can tweet out your question, #Swatantra, or join us on our website, www.bswatantra.com. It'll be our pleasure to hear from you. We're talking about mistakes that we make as investors and how we can avoid those mistakes or fix those mistakes and become better investors. I do believe we have more questions from the audience members. Yes, ma'am, go ahead.
My question is that when I'm going to invest in the mutual funds, what criteria should I use for that? Because whether it's the past performance or any other things.
No, past performance cannot be guaranteed in future. What was the past performance of any particular product cannot be a guarantee for the coming period of your investment. So you have to take that calculated risk while investing, and accordingly, whatever is your appetite of risk, you can go for a balance fund if you don't want to go for an equity fund. And again, while suggesting to our investors, what we do is we profile the risk appetite of the investor first, and then only we give them a product which is suitable for him.
Actually, even if you do your risk profile, let's assume she has decided that, okay, I'm going to invest now for the next 10 years. My goal is 10 years away. I have 10,000 rupees to invest every month. And now she has to look at the entire universe of mutual funds, and there are so many funds to choose from. There's large cap, small cap, mid cap. Within that there are various different companies. Within that within each company there are different funds. So if you were to help her actually narrow down that process, how should she do it? Do you want to take this first?
Yeah, see, basically it will be based on the goal what she wants to achieve after 10 years.
Okay.
So it will be bifurcated. For example, if you take a broad picture, then it will be bifurcated into equity, debt, gold and various asset classes according to her goal. And once we achieve that, then we will shortlist the product.
And her age, she should go for a 40% of equity, 30% of balance and 30% of debt.
Okay, 40% equity, 30% balance, 30% debt.
At her age.
Okay.
If some younger one is going to invest, I'll say we can put 100% into equity, no problem.
Okay, so let's assume then that we're using your asset allocation, which is 40% equity, 30% balance, 30% debt, which is effectively 60-40 equity debt, because if you break up the balanced in it as well. So now where should she invest the money? Now how does she pick the funds? Now that we know what the split is.
Now again we will be suggesting her the fund, in what fund she has to invest.
How?
I'll be picking up one of the large cap, one of the mid cap, and maybe diversified fund is better option for her. And same thing again, I will again come to the younger generation where I can give.
No, let me take you back again. You said you'll pick one large cap, one mid cap, or maybe
or
an
diversified
okay,
fund.
fine.
Yeah.
Let's take the large cap fund.
Yeah.
How do you narrow down among all of the lists and pick one large cap?
Certain funds which are performing good in good times, but certain funds which are performing better in a bad times also.
Okay, over what period of time?
Say 5 years.
But she's investing for 10 years. Shouldn't she take a 10 year?
I am taking 5 years back performance.
Okay.
For her next 10 years goal.
Okay.
So it can be maybe a combination of 2-3 funds. Even if my suggested one of the fund is not performing, the other two will take care of her goals. No problem.
See, once we narrow down the schemes, okay, for example, if we are narrowing down on the scheme, we see as you said, for how long she intend to invest. Accordingly, we will go back to that time period for previous 10 years. We will see how that particular scheme has performed in bad times, good times, and there are parameters which we go through, that is Sharpe ratio, beta ratio, how scheme has outperformed the benchmark consistently, and once that is finalized, we will allocate the schemes. And once schemes are allocated, it is important to track those schemes as well. Not on monthly basis or quarterly basis, but at least 6 months to yearly basis, that whether that scheme is still outperforming the benchmark index. And if that scheme is not outperforming the benchmark index, then it is essential for us to change the scheme and shift to better scheme.
Okay.
So that way it will happen. It's not just that we'll have to sit on the investment.
Periodically we have to take the stock of the investment what we have done. We have to assess the things, and suppose if something I have suggested today and down the line 1 year the same story is not there and the fund is not performing, I should have guts to change that fund, to convince her and change the fund.
No, okay, so if I'm investing for 10 years and the fund has not performed for 1 year, is that enough reason for me to switch out of that fund?
We can, because if say political scenario or global scenario has changed, for example, I'll take you some time back, some few years back infrastructure was in a limelight.
Did you recommend any infrastructure funds?
Today I will recommend, but 5 years ago, earlier I had recommended, but it didn't work. So I had that guts, I had called all my investors, I have changed that fund to something else, and they are happy today.
No, so tell me something, if you recommend infrastructure funds today, like you said, wouldn't I be better served just using an equity diversified fund, because my fund manager will pick the sector anyways,
Absolutely,
right?
we can.
So
we don't have to go for a sectoral fund. We can use diversified fund where are there some of the infrastructure stocks in it, built in it.
okay,
We try to avoid sectoral funds.
you try to avoid sectoral funds.
Yeah.
Okay. So ma'am, I think basically the advice that you're getting is, once you know the period at which you're going to invest, depending on your risk appetite and depending on how far away your goal is, you can decide how much equity you should get. Ideally, the longer the investment, the higher the equity, and then choose a fund with a good track record that has done well over a long period of time and has beaten similar funds in its own category. The longer the track record, the better. All right, on that note, we're going to take a very quick break. And if you also want to be a happy long-term investor who's satisfied with how his money has done at the age of 60, you want to stay with us after this break as we talk more on how we can be smart investors. Welcome back. You're watching the UTI Swatantra series powered by ET. Now, a quick reminder about our website www.bswatantra.com, or you can tweet out a question if you have it to #Swatantra. All right, let's quickly answer more questions. You have another question, sir. Go ahead.
I would like to add one more question. See, is there any time in the lifespan that this is the right time, or now at the age of say 58, 60, it is too late, or is it like that?
That's an excellent question. Is it ever too late to start an investment?
जागो तब सवेर है.
So basically, it's never too late.
Yeah, it's never too late. You can invest anytime, in any time, lifetime, no problem. I have clients as old as 83, 85, 90 years old. They are into equities, I tell you, and they are happy investing in equities even today.
Actually, so okay, let me ask you this. There are a lot of investors, especially the younger ones who are sitting at the back, who are not saying anything, who will normally tell us that, listen, my money gets over at the end of the month. Or I'm trying to save, when I manage to save 2 lakh rupees, then I will start investing. So there are lots of, investing is a lot like fitness and exercising. If you get up in the morning, it's always an excuse not to go not to go to the gym. So like that, there's always a reason to put it off for a later date.
For them, yeah. For younger generation, I'll tell that they should start investing when they receive their first salary. Because see, basically, we don't have social security here in India. So the day one you start getting your income, you should think of your retirement and start investing from retirement point of view. You start younger, you will retire richer.
There are two things to it. One is ignorant class who doesn't care that we'll see after 35, 40, and they don't indulge into any kind of investment, and they start too late and they suffer from it. And second class is they start enthusiastically, and then in between they stop. So I give just 2-3 statistics to them that if you do SIP for 5 years and just 5,000 rupees, then your corpus becomes 550, for 10 years 12 lakhs, and 20 years it's 50 lakhs. So incremental SIP, what usually happens is...
Actually, so tell me this then, I'm going to ask this question on behalf of the young men sitting at the back. If, let's assume my salary is 100 rupees, so that we can do a fair breakup. How much of that should I be investing every month?
30% of it.
30% of that money?
Yeah, absolutely.
What if I pay a very high rent living in Bombay?
Then at least try to save at least 10 rupees of it.
Okay, so at least 10%. At least 10%
yes.
We have to put in. Also, it's important to remember as young people that the minimum investment on a monthly basis in a mutual fund is 500 rupees. And even if you can start with 500 rupees, it's a good enough start.
Very good,
right? It's
very
a good
good
enough start. All right. Do we have any more questions, sir? Would you like to ask anything else? Sure.
Regarding the inflation rate, how do you advise? Say, as you said, for younger generation, they should start for the retirement and this thing. How can they predict, or how much value of the rupees will be at that time? Whether they have to take this aspect while doing the investment?
Actually, that's very interesting, because right now we have a very high rate of inflation that the government is actively working at reducing. We know that the comfort rate for the government is between 4 and 7%.
Absolutely.
But there's no reason why, when all of these young people are ready to retire, that it doesn't drop to maybe 2 or 3%, because that's where the rest of the world is right now. So how do I decide what the inflation target is and what I'm trying to beat? Aditya?
Yeah. See, inflation is extremely important factor, and for that reason only we try to invest more. Because in developed countries, inflation has been, as you said, has been 1 to 2%. See, but only thing is in India, if we want to grow at 7%, 8%, then eventually we'll start again seeing inflation going up a bit again, so that our purchasing power will keep on reducing. So inflation is the most important factor which needs to be considered while investing, and inflation plus that.
How do you calculate that? When you say that you have to work in inflation?
See, for last 10 years, inflation has been average 6.5%. Average rate of inflation, which I've seen the 9.5% inflation also, and 5.5% inflation also during 2006 and 7 period. So we have to take the average and mean of it for last 10 years, and then only we will able to arrive. And by seeing the growth prospects, see, inflation will come in India with growth for at least next 10 to 15 years. If we don't grow, and if we want to grow, then it will have to be the inflation rate growth.
Absolutely.
So
okay, so tell me this. If right now our inflation rate has been on an average 6.5%,
yeah.
and it, for whatever reason, drops tomorrow, will my equity returns also drop similarly?
I don't think so. Equity, see, I'll tell you, Why we suggest people to go for equity? Because equity is one class. Year on year, now we have an history of 140 years of Bombay Stock Exchange. You go and see the means returns delivered by the equity in the last 140 years. You take any 10 years period time, it has delivered you a return of 15%. Any 10 years time, in a bad times also, it has delivered 15% returns. So equity is one such asset class which will beat all the asset classes.
But if inflation is low, and then that would mean growth is low, which means equity returns would be similarly low.
It's not necessary. In 2007, in the last cycle, inflation was lowest and we were at the highest market at 21,000.
Okay.
When inflation was lowest. So it's not necessary that lower inflation will lead to lower market returns.
Okay.
So
again, why I promote mutual funds investment, because if I'm doing some FDs or something like that, I'm going to get 8% returns. Plus when you consider the TDS on tax on it, my actual returns real returns come to 6.5, and my inflation rate is 6.57 as you said.
Sure.
So my income is negative, or rather nothing I am getting from my investment. So I am generating negative returns. To beat that, I am taking some calculated risk and putting some my money into balance fund or equity fund, which will at least beat the inflation.
All right, it's a wrap on the show. Gentlemen, thank you so much for joining me on the panel. Remember, if you have a question, feel free to write to us. Our email ID is at the bottom of your screen, so is the website at which you can get in touch. Thank you so much for watching. Stay with ET Now.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.